Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode is brought to you by Stream by Mosaic. You can find them at streamrg.com. That's streamrg.com. Stream is an expert interview transcript library that's become integral to my research process. I first discovered them 14 months ago, roughly, when they were still building out their product, and it's been incredible to watch them grow their expert interview transcript library over time. They have a number of interviews on a wide variety of companies, and I can't recommend the service enough. It has truly become integral to my process. Stream by Mosaic provides over 300 expert interviews per week. 70% of their experts are found exclusively on Stream, and each interview goes through 3 layers of compliance screening. Recently, someone said to me that Stream is table stakes for good fundamental analysis. I couldn't agree more. This episode features Jonathan Boyar. Jonathan looks for companies trading at a discount to what a rational acquirer would pay to own the entire company. He is the president of Boyar's Intrinsic Value Research, LLC, and you may know him as the host of The World According to Boyar, a podcast. In this episode, Jonathan and I discuss Scott's Miracle Gro, and I was perusing Stream's library to get a sense of what Scott's is going through. You can see on the stock chart, there's been a lot of volatility in the name recently. Seems to me that there's some market discussion over whether or not COVID is a sustainable trend for their business or whether or not it was a one-time bump that people are going to sort of fade away from. They've got a really interesting part of their business that sells hydroponics, which is obviously a tangential cannabis play. I found one excerpt of an expert interview interesting. The expert was the former sales director of Walmart and Sam's Club. And they were discussing Scott's claims that 70% of millennial homeowners are into gardening. And the interviewer was asking the expert whether or not he believed that. The expert said, "Millennials told us in research that they found gardening as a respite. It was an escape for them. They talked about plants as if they were part of their family. They would refer to them as being their plant kids. They would call themselves plant parents. It's very similar to the way you see some millennials refer to their animals, and that's their child. The plants are definitely something that's become a very real, tangible being to them in some form or fashion. Very interesting, their mindset." I would agree that's very interesting. I personally have never seen a plant as a kid, and I've killed every single plant that I've had, along with all the fish, but I digress. Anyway, please see streamrg.com, where you can sign up for a 14-day trial to get a more robust understanding of Scott's or any other company you're interested in. Please tell them I sent you. It means a lot to me. It'll help me in future advertising. Thank you very much. As always, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. I hope you enjoy the episode. So, Jonathan, thank you for joining me today, and hopefully we can get this done while both of our kids are out of the house and we're both relatively productive before we're both getting screamed at by young children.
Yes, and I apologize in advance for any background noise, etc. Young children screaming, but comes with the territory.
You may hear one running above me right now. He's home. Actually spent the night in the ER last night, which wasn't great, but it wasn't nearly as bad as it may sound either. So that is okay? The life of having kids.
He's okay now, though?
Yeah, he was fine. It was an issue, but we don't need to get into exactly what it was.
Yeah.
Okay. A little bit of medicine, and he's all good. Anyway, man, first of all, thank you very much for coming on the show. I want to give you a opportunity to tell people who you are, where you're from, and all that. But first, I am going to give a major shout out to your podcast. Your guest list is incredible. I was actually just listening to you and Zaslav yesterday. The guest list is very impressive, and it's very well done. And I find your research very well done, too. So with that pitch out of the way, why don't you tell people who you are, where you're from, and what you do a little bit, and then we'll get into it.
Yeah, no, absolutely. And first, thank you for having me, and second, thank you for the kind words regarding the podcast. It's the best part of my job that I don't get paid for. Love it, and it's just a lot of fun, and I learn a lot, and I get to meet really cool people.
Yeah,
which is awesome. I'll give you a really brief background. I help run the Boyar Value Group. We've been around since 1975. Clearly, I'm not the founder. The founder was my dad.
Very well, sir. You found a view.
Value investors do live for a very long period of time, but it doesn't necessarily mean they age well. It was started in 1975 by my father, Mark, who's still very much involved in the company, especially in the idea generation part of it. And, started really simply as a boutique, as a Wall Street research boutique, selling independent research to, hedge funds, mutual funds, family offices, whatnot, insurance companies. And over time, my dad developed a pretty good reputation in the value investing community, and people started asking him to manage money, which he did. And in 1983, we formed Boyar Asset Management, which manages money for both institutions and high net worth individuals, and we have a couple of other vehicles. And so to this day, we really have two businesses. We have a research business where we still sell our research on a subscription basis, and we manage money. But I think the unique thing that we do is how we do it. We take, we're really long term. We take, what we like to call a business person's approach to stock market investing, where we look at every company through the lens of an acquirer. What would a knowledgeable business person pay for an entire business? And that's the framework structure that we look at each and every company. It could be a microcap company, it could be Home Depot, it doesn't matter to us. But we think it's a great way of looking at things. And through the years, it's worked pretty well. And we're not a big marketing shop. We just love what we do. We love producing research. We love managing money, and we think we have a unique long-term approach to it.
Did I hear correctly? Did you work for Gabelli at one point?
Yeah, Mario was my first boss out of college. He is a fantastic investor. I've learned a ton from him, and I'm still in contact with him. He was actually a guest on my podcast. He was generous enough to appear. I know you have met him as well. I think in Omaha, if I remember correctly. And I really hope this year we're all back in Omaha, and he can have his, I guess, Friday night conference there with Columbia.
That's a fun night.
It is a fun night, and it's just nice to think that I'm not going to be stuck in my house for the foreseeable future.
Yeah, it'll be interesting to see if those guys meaning Buffett and Munger, really want to do it, just given their age. But I do hope that I agree with you. I hope that we go back to Omaha because it's a great weekend. It's one of my favorite networking weekends in the world. And if Omaha is over, then we're all going to need to find somewhere else to go. Who knows? Maybe it'll be some events that I put on or somebody else puts on or you put on. I don't know. But Markel's got a decent shot at building something. So we'll all kind of see how that all shakes out.
Well, it's interesting. I mean, there'll never be. There could be something that's just as good, but what that is just such a unique circumstance that grew and grew over time, and it's just the whole Berkshire, empire. I mean, that's something that's just not going to ever be replicated, and that weekend is just really, really special, where you have relatively like-minded people there, and as you said, the networking and just seeing the same people year in, year out, it's just a really nice thing.
Yeah, I think the thing that's really cool about it is, since everybody is like-minded, if you approach people and you're genuinely interested in what they do, it doesn't matter who they are. Like when I met Mario, I just said, Mr. Gabelli, I had actually asked him a question about, I think it was MSG and James Dolan when we were in the room. And he, what did he say to me? He was like, "You're from Chicago. You don't understand New York real estate. You don't need to make money with him if you don't like it. I like him. You don't need to like him. Let's move on." So I was like, okay. And then later on that night, I said, I'm the one that asked you this question. Do you mind if I buy you beer? And, here 2 hours later, right, we're still chatting. And it's just incredible. Like, for a guy, especially like me at the time, I don't have access to somebody like Mario Gabelli. So it's very cool. And that's representative of everybody that I think goes there. It's a fun event.
No, absolutely.
So do you all, if somebody's listening, do you all specialize in a coverage area in your research, or are you pretty broad? What is Boyar focused on these days?
Yeah, I think that's another thing that kind of separates us apart and makes us unique. I mean, right now, generally sell side or, research is kind of divided into two camps. You have the traditional sell side research at JP Morgan, where you just get a lot of stuff, some of it good, some of it not as good. Or you have, industry specific analysts who, have hung up a shingle over the last couple of years and, will just, if you want telecom research, you go to X or Y or whoever, or media research. We think one of our advantages is being a generalist. So we'll look at anything that's kind of US based, any market cap. We actually, one of our favorite areas to look is microcaps, but, a lot of firms can't look at it. So we started a separate service a few years ago called, or more than a few years ago, about a decade, called Boyar's Microcap Focus. So we'll look at any industry as long as we think it's cheap and as long as we think we can add value. With that said, there are areas that we tend to gravitate towards, and there are areas that we tend to shy away from. We've never, for better, for worse. I mean, this year for worse, we don't really look at energy names, but last year when they were down 37%, that helped us, I guess. So you won't see much in the way of energy or, heavy technology or kind of any situation that has a binary outcome, because it doesn't have that margin of safety, put in there. So you'll see a lot of media names, communications, consumer. We love branded goods. We think those are very, great, and you'll see financials, industrials. So anything you can really value and analyze. The reason we don't like energy names is you have to have a view and be able to predict what a given commodity like oil is going to go for, which I think is almost impossible to do. And if we're looking at everything the way an acquirer would, I would never want to own a business in its entirety that's profitability is entirely dependent on a commodity that is totally outside your control.
Yeah, that makes sense.
So we'll look really as a long-winded way of saying we'll look at anything. But I think also the other thing that makes us a little bit different is we're, while value is in our name, Boyar Value Group, we're not necessarily your traditional Graham and Dodd investors. While I have great respect, it's one of the first investment books I've ever read. We're more of a quality bent. We like, looking for more, higher quality businesses, while we will look at some lower quality businesses. The vast majority are in the higher quality camp, but we'll also look at some not quote unquote non-traditional value, where maybe there's something there that's not necessarily, it's not cheap traditionally, but for example, let's give you a brief,
I was going to ask, what's an example?
Not to take a victory lap on something, but one of the names that one of our analysts came up with, I guess it was last year in May, was Twitter. It's trading around $35 a share. It was basically pretty close to its IPO price, and it had a value. To us, it wasn't crazily expensive, but to us, one, it was under earning relative to what we think it could do, and the second thing is it built up a network and a brand over its existence, that is unbelievably valuable and would be almost impossible for someone to replicate quickly.
Yeah.
So to us, it's not just, looking at the financial statements, it's looking at other things like that. And, we did the same thing. Maybe it was, I think, 2016 or so with PayPal. Wasn't statistically cheap. But, the network it had was, we thought, unbelievably valuable. So, we're not your traditional value investors. That's not how we started. We did, when my father started the business, it was more of a Graham and Dodd, low quality approach, not in terms of the research, but in terms of the type of
businesses.
Company. And that was because, and to me, it's amazing. Like, this calculator was like the modern technology then. That was your edge. And, there were very few people doing the work to find these situations. And you can find companies that are trading below, their net working capital, those type of things where today that's kind of arbitraged out. You have plenty of hedge funds who are finding these things, but it does, so we're looking at those type of situations, where if there's a best way to describe us, it would be eclectic.
Yeah. I've heard you pitch IAC and a number of different things. We'll get into some of that. But when you're looking at microcaps, has the landscape changed at all? And the real question that I'm asking is, how do you find quality microcaps that sort of haven't had a takeover bid by private equity, or maybe haven't been acquired? Like, what is the reason, if a listener out there is saying, well, I don't want to step into microcaps, it's a bunch of junk. What's the reason that like a quality business would still remain public and be a microcap?
Through the years, we've just seen through our service, just great businesses, that you would have known a lot of them. Winnebago was a microcap. Still $500 million, whatever it was then, is still a decently large business. So there are, Martha Stewart Living, for example, was another one that we've done. So these are great businesses that are just small. But what we really look at we look for founder led, or someone who's running it who has a big controlling stake in the business, because maybe they're not just selling out to the immediate highest bidder. They're trying to build long-term sustainable value. So there's many reasons why someone would choose to stay public, and over time, a lot of the names have been eventually acquired. But if you find these great businesses that just aren't well covered by anyone on Wall Street, that are majority owned by founders, generally good things could happen. Like everyone, we've had blow ups, but for the most part, these have been pretty good investments, and we have a track record that I'm extremely proud of. Our team has done a great job, but you have to be really selective. You can't have a service that does 30 names in a given year. That's just not going to work. There's just not that many quality ideas out there. One we recently did, and I believe the CEO was on your podcast, I think. Sorry if I got that incorrect. It was Diamond Hill.
Oh, he wasn't, but maybe he should be, or she.
She wasn't on your.
No, I'm sorry. Yes, absolutely. Heather Brilliant. Yes. My apologies. Yes, she was. Yeah. For some reason, you said Diamond Hill, and my head went to energy. But you recently said that you don't do energies.
She's fantastic. She's the first professional CEO they brought in. It's an employee-led, employee-owned company that's in it for the long term. They just issued a very large special dividend a couple days ago. It's been a really big success for us. But this was kind of the things that we look at. These kind of not the most exciting business, but a unique boutique money manager that has a good long-term track record, that is very shareholder friendly, and pays a nice regular dividend, and has a history of paying special dividends that I think at the right time probably will be acquired. I'm not saying they will, but you're seeing all these
Yeah, it's
asset
sort of the
managers.
natural progression of asset management, it seems.
Yeah, and maybe not in this case, but the way we look at businesses are in the same way as an acquirer would. So it happens that a lot of the companies that we research end up being taken over. And as I said, I'm not saying Diamond Hill will. And one of the things that's kind of unique about them is they limit their capacity, which is very rare in money management these days, and that served them well.
Yeah, I think that's a smart idea too, because you've got the old CEO. I mean, Heather wouldn't say this, but I'll say it. If you follow when the old CEO was sort of told to maybe go into retirement or not, and now you bring in somebody that sees, like, something I like about Heather is she sees value in not like sort of the traditional value way, right? So the possibility of them pivoting, plus new management. I've heard from a couple people that work there that they really, really like her. That's a good setup.
Yeah, to us, it's something that's really,
it's the old value really, with the catalyst.
It's definitely that's 100%. One thing that my father really has instilled in me and instills in the team is you can find the greatest company in the world. It's not going to go up in price. It's not going to do you any good. There are still companies that are still around that were cheap in 1975 that are still cheap now. There has to be a reason for the stock to go up. And I'm not saying it has to go up tomorrow. We're patient. We take, I think our average turnover is 10% in our money management account. So we'll, it's like watching paint dry sometimes, but it works.
Yeah.
But you have to have a reason for the stock to go up. Otherwise you fall into these value traps. So you look for a catalyst, and in almost every name that we buy, there is a catalyst. I mean, value can be its own catalyst, but it can get you caught in a lot of, statistically cheap but not great businesses.
Yeah, I think where I'm morphing more and more to is if value as a catalyst is framed as like a growing cash flow stream that may turn into buybacks, or something that creates like upward pressure on the flows in the stock, that I kind of understand as a catalyst. But just sort of, I think this should trade higher and it doesn't trade that high, I am not very interested in those ideas on average.
Yeah, you can end up with like a Tootsie Roll or something like that, which is, I think it might have gone up recently, but it was cheap for like decades.
Yeah.
So those are the things you want to avoid. I mean, I think generally value managers, their biggest problem is running into value traps. I mean, obviously you do have in some cases, permanent loss of capital that happens to everyone, but a lot of the mistakes I think, value managers do make are just, dead money, which is a legitimate mistake, and that's something you have to really try and avoid.
Yeah, that's interesting. I have wondered if some of the mistakes have been related to like this idea of, and I don't know how everybody runs a value book, so it's not really fair of me to say, but like the Buffett idea of waiting and waiting and waiting and then swinging, I think makes a lot of sense. I have sort of started to gravitate and flirt with the idea of smaller positions in companies that can grow a ton, following them and averaging up over time. I don't think it necessarily needs to be a binary answer, but as somebody that was not formally trained in sort of the hedge fund world or like at a real value shop, a little bit more of that Motley Fool approach I've found it interesting to at least think about.
I think it's whatever works for you and what feels comfortable to you. I mean, some people can go all in on a stock at one time. That's not necessarily my style. I kind of either try to average up or average down, depending on obviously the circumstances. But you also don't want to, I mean, two things. You don't want to be caught just blindly buying something because it goes down. You have to really, the market might be telling you something. Is there a reason why it's going down? Is it just market sentiment, or is there something you're missing? But I think the other mistakes, and this is another thing that, I've learned a lot from my dad, is selling too early is a huge mistake. and it's something that I'm trying to get better and better at. And I look at what has been the greatest sources of our gains over the last 15, 20 years or whatnot. It's been holding on to some of these securities. Two examples, and I'm not saying every company is like this. I mean, these are obviously the outlier results, but like buying Home Depot and Microsoft in I think the low 30s, and basically just sitting there and holding it, even though they've gotten a little bit more expensive. But if you have a great business, and it's compounding nicely, just to sell something for the sake of selling it, or to quote unquote, manage the portfolio and have like these neat weights into it, or I think just it's not in the client's best interest. If you find a great business, especially in taxable accounts, you should hold on to it until it gets dramatically overvalued where it makes sense to sell it. And that's one of the things that I've really have gravitated to, and have learned a lot over the years. And those are the two big examples, and it's the magic of tax-free compounding.
Yeah, well, it's the old letting the right tail do the work. I think as I've pondered this idea, I've determined that the key is to define a great business in the right way, right? So you got to be pretty critical of the definition. But I do think that there are objectively some of these businesses that a younger me would have sold that now. I mean, I was actually looking at Microsoft today, given their results, and it's like, even here, right, it's trading around, I don't know what I saw, like a 2.8% free cash flow yield or something like that. If somebody wants to tell me that it's going to underperform the average sort of basket of value companies, I guess I can kind of understand that argument just on a multiple basis. I'd probably fade the argument, but I know I'd rather own it than bonds. So, yeah. And I think it probably has less risk than your average value company. So if it underperforms, I'm not even sure that's an inefficient outcome. Where a younger me would have been like, I don't think that you can hold anything at that multiple. But that younger me was dumber than I think the current me is.
Well, you're supposed to learn, and that's the idea. And
yeah, it would be a shame if I thought exactly the way that I did when I was younger, right? That wouldn't be much growth.
No, it wouldn't be much growth. And what to me is also the amazing thing is the sentiment. Maybe not as much with Home Depot, but I mean, Microsoft 2007 was just hated. I mean, whenever I pitched that, people just said, wow, what a terrible, terrible idea. And for years it was, 4 or 5 years, it was somewhat dead money. I think it went from 20 to 40 or 50 and back. But at the time, I mean, it was just unbelievably cheap. You got a good dividend. And clearly, you could never have guessed, what they would have done. But it's also amazing how a value stock can become a growth stock. And it's just. But if you're able to buy that great franchise and have to, not listen to other people, you could have some winners.
Yeah. I'm about to say something that people should not listen to because I have no idea what I'm talking about in this, and semis is super freaking hard. But Intel, like, kind of, when I saw that announcement that they were going to spend a bunch of money, there was a part of me that said, and the stock traded down like 10% on the last earnings call. There's a part of me that sort of wondered, like, okay, are the governments supporting them? Is this like sort of one of these geopolitical strategic assets? And is this sort of Microsoft from back in the day? And if they can start to turn it, is this one of those that in 10 years people look back and they say, well, of course, Intel, that was when it changed, or whatever. I think that where I've kind of gotten on ideas like that is, rather than saying, yes, I know, first of all, I don't know semis, as I just said. But second of all, if I have that premonition that that's a possible outcome, I think I'm more patient in waiting to prove the thesis rather than trying to like bottom tick it.
Yeah.
But that's how the real big gains come. Well, some of the real big gains come, right?
And trying to bottom tick it it's impossible. I mean, that, everyone has their own way of buying things. I like to buy things slowly over time. Other people kind of maybe are a little bit more aggressive than I am, and that's just what you're comfortable with. But they don't ring a bell at the top, they don't ring a bell at the bottom, and that's why I kind of like to average into things.
That makes sense to me. How long or how many ideas in your research do you sort of try to put out per year? And I know that I'm not trying to hammer you down, but the real question that I'm asking is, we live in like this Substack world that's 2 articles a week and all this, and it sounds like you're much more selective. And when I've seen you write up an idea, it's very detailed. I have an immense amount of respect for the research that you guys do. But how is there a tension between like putting out more content versus being right, or is it not even really an internal discussion?
Less is more.
Yeah.
And we have a fantastic team that produces the research. I mean, they do a great job. Everyone has their own strengths and gravitates to their own thing. And I'm really proud of the work we do. And we just basically have a publication schedule where essentially in a given year, you get X amount of reports. I think it's roughly 25 full-length reports. And then we have something that comes out in December, which is really cool. It's called The Forgotten 40.
Yeah, I like The Forgotten 40.
Yeah, no, I'm glad you do, and I'll send you a copy this year when it comes out. We actually do mail things in hard copy. We're one of the few supporting the post office. But the Forgotten 40 is our 40 best ideas for the year ahead. And what we do is we take a look at our universe, anything that we publish since 1975. I mean, obviously we don't go back that far, but is fair game. But we've had to have published it, and we say what's going to go up, we think, the most in the year ahead. And why. So what we do is we just do these one-page snapshots and give our investment thesis for each company. And in today's kind of ADD world, having these one-page snapshots that are backed by really deep research, and it comes out when people are rebalancing their portfolios, is something that people really enjoy. So we do less. I think we do it better. We have our style of doing it, and we don't want to dilute it. I mean, I think 25 full length reports in a given year is a lot. If you can come up with 3 or 4 really great ideas in a given year, I think you've done your job.
Oh, for sure. That's why I was wondering, like, is there an internal goal? And I think 25 is really hard to do. Right. And
yeah.
Of those, I assume some are not actionable. Right. And it's just kind of this is on the watch list, maybe interesting. And then like 3 or 4 real table pounders. I like this idea right now. Right. Is that fair?
Well, our subscriber base is relatively diverse. We have some, more of the deep value camp. So we have just different type of ideas.
Yeah.
And we don't say to buy anything. We just say this is selling at X% of discount to our intrinsic value. You make your own decisions, and everyone has their own reasons for doing things. And our subscribers are fairly sophisticated, and they use us as a starting off point. We just try and really get people to think. Everything we write about, we truly believe it's undervalued, but whether it's the right time to buy it is a different question. Yeah, and for us, because we manage money as well. And we believe in relatively concentrated portfolios. As I said, our turnover is roughly 10% a year. Clearly, we're not buying every company that we write up. Just portfolios have become just way too large. But we do, we have conviction in everything we write. But some ideas, obviously, were more table pounding. For example. We recently did Scott's Miracle Gro, which I think is an unbelievably interesting company. It's gone down from $254 a share to about $150. It has Coca-Cola like market share. It's a great business, huge pandemic beneficiary.
It's got a little bit of a cannabis angle to it.
That was the other thing. It has cannabis. It is the biggest distributor of hydroponics in the country. And right now, the way we look at it is you're buying the traditional business at these prices and getting the cannabis business for free. And one of the reasons really two reasons why the stock has gone down is one, their gross margins are going down because their cannabis business is growing pretty quickly and has lower margins, but those will improve. And they're also investing in the business because it's growing so much, which is causing margins to temporarily go down. So that's one reason the stock, we think, has been impacted. But two, if you look at cannabis stocks since April, when Scotts started to go down, they're down.
Yeah, everything's been crushed.
Yeah, and that's giving you an opportunity to buy a great business. We've been following Scotts since 2011 when it was, I don't know, $50, $60 a share. It's now $140, $150 or so, down from $240 in April, or $250 in April. And we think it's probably worth $240 a share at current levels. But if there are catalysts that could make our estimate of intrinsic value really, really conservative.
Yeah. I tend to follow Turning Point as sort of a derivative cannabis play, but I like those ideas, right? You sort of have a standard product that you can bank on the economics of, and then you've got a growth engine that is sort of like a free option, for lack of a better term.
Yeah, and you also have a great capital allocator. You have the Hagedorn family, who Jim runs the business. His family owns, I think, 27-30% of the company. They buy back stock when it's cheap, and when it's expensive, they pay special dividends. And they do that because it's their money.
Yeah.
And I like and I think they haven't dismissed the idea that at some point in time they could split the business in two, and it wouldn't shock me.
Yeah. Well, you get different investor sets potentially, right?
Yeah, very different. I mean, different growth profiles. I don't know how active Berkshire is right now, but the traditional Scotts business.
That would fit nicely. That's like a Buffett business, isn't it?
It's a great business, and it's really aided by the pandemic, where a lot they have. I think they brought in 20 million new customers who've gotten into gardening. Millennials love gardening, and the shift from the city to the suburbs has been a big tailwind for them. And they should.
What kind of dog do you have?
You hear Newman. He's my golden doodle.
Oh yeah, we're getting a golden.
My kids must be home. Maybe we'll give it 2 seconds for him to calm down.
Yeah, no, it's all good. We'll get back to it. We just signed up to get a golden. So
great
the
dog.
Children are very excited. I grew up with labs, so I figure most retrievers are sort of similar, right?
They're just fantastic dogs. Times like this is less good.
Nah, that's fine, man. It's a nice moment. This is a work from home moment right here.
This is an absolute work from home moment. When are you getting the dog?
Well, I think that we are going to get it on Christmas. We'll see. The kids don't know that it's coming, so
nice surprise.
Yeah, that's right. Put a bow on it and see how it goes. So
yeah,
I don't know.
First couple of months are tough, but it's like having a little kid. It's like having another kid.
Yeah. Well, my agreement with my wife after our youngest, like once he became 2 or 3 or whatever, I was like, I'm never doing diapers again. And I actually took care of the ability to procreate. Anyway, I digress. But I have no desire to have another child, so a puppy's gonna be the substitute.
They're fantastic. They're great for kids, great for the family, and as I said, except for situations like this, I love having.
Yeah, well, I think it's happy, man. Does a golden doodle smile like a golden does?
Yeah, he's just always happy.
That's awesome.
They're happy. Yeah, so it's great. And I'm a big Seinfeld fan. So my first dog was Cosmo. My next dog was Newman.
Oh,
so
nice. Newman. Did Newman behave himself, or did he try to sabotage you?
Yeah, exactly. I mean, that's Newman.
Yeah. I'll tell you what, man. I'm pretty interested to see the Seinfeld numbers on Netflix. I think they're going to be crazy.
I'm looking forward to having the time to actually watch it again. I mean, it used to be on here Channel 11. Now it's I haven't had my Seinfeld fix in a long time, but yeah, it's awesome.
Did
But yeah,
you
those
ever
numbers.
watch them with the DVDs?
No, I mean it was always I would just watch it when it was on linear TV.
Yeah.
It was great. I never got the DVDs. Now I don't need them. I have.
So
But
you have never watched it just like streamed episode after episode?
no,
It
I've
is
never.
such a treat, man. The
Oh,
first
great.
season, the first season, like, I don't know, I'll be interested to hear your take, but I remember there was a part of it where I could just like see the chemistry click between all of them, and then it was
Yeah,
just off to the races. And watching them
yeah,
in order, all the jokes that refer back to previous episodes like all made sense to me. Because like
yeah.
you, I would watch it in syndication or whatever, and the episodes were all chopped up and I kind of didn't understand. But watching it sort of, chronologically is just amazing. I'm looking forward to
No,
doing it again too.
yeah, no, I'm glad. No, I definitely will be watching it. I'm a big fan of that. I don't get to watch as much TV as I would like, but this is definitely worth it.
Isn't that it's an NBC property, right?
Yeah, no, it was
Yeah.
NBC, and they have some NBC references with some of the people there. But yeah, it was NBC, and God, it was just one of the best shows of all time. And I'm a fan of Curb too.
Yeah, Larry
I think that's
Davidson.
coming on.
Awesome, generally.
I think that Yeah, I think that's coming on soon too on HBO.
It's just wild to me that that NBC would license that content to Netflix. I mean, I understand why, right? You want the cash in the door today, but it's like that's such good filler content for Netflix that you're
Yeah,
just like giving them retention. In a time when I would think if you're really trying to lean into Peacock, which I would argue maybe they're not, but like you need stuff like that on the platform. You can't have that go off platform if you're serious about competing. I don't think.
yeah. I don't know when the deal was made, how long. I didn't really follow it closely, but yeah, I mean, if they want people to go to Peacock, that would be a good, you know,
Yeah,
a good thing to do. But yeah, it'll be interesting to see what their strategy or what they do with Peacock. I mean, this that whole streaming ecosystem. I mean, we're fans of Discovery. I had Zaz, as you mentioned, I had Zaslav on a podcast. I mean, seeing how that's going to turn out is really interesting as well. How many different streaming services there eventually are. You know, they're thinking they're doing the CNN Plus, whatever they call it, but we're not going to have 15 apps, so streaming services. So it'll be interesting to also see how that ends up shaking out.
yeah. I need my beloved Curate to get QVC in a bunch of different bundles. We'll see how that all shakes out. As you said, I liked your Zaslav interview a lot. I find myself always intrigued by Discovery, but you talk about a stock that's dead money. It like just hasn't done anything for years and years and years. But the business, I mean that Scripps acquisition, I think was smart, and I don't know. Whenever I hear Zaslav speak, I think this guy we may see the world very similarly, but for some reason, I don't know. I just haven't gotten there on that business because I'm not 100% sure what like he said to you, if you could watch anything in the world, why would you watch our content? And I know he's got an answer. I'm not sure I buy in, but with HBO Max, that is some serious content that they're about to acquire.
Yeah,
So
no,
that could be the reason.
it's serious content that's been neglected for 3 or 4 years as well. So are they able to resurrect a lot of it? I mean, they've been in true corporate ownership. I mean, they're owned by a telecom company for the past couple of years, and they got rid of all the real talent. And I think Zaslav hopefully will be able to rejuvenate it. And I think it's telling that Malone gave up his voting control for this. I think this will work out in the end. It's obviously been disappointing, the reaction to this. But I mean, we're patient. I wish during the whole Archegos I had sold more. We sold, I think,
Yeah,
about a
that was
quarter.
crazy.
Yeah, I think I sold about a quarter of our position. I wish I had, in hindsight, sold more, but we took some money off the table, and now you have a chance to buy some of it back. I think at reasonable at reasonable valuations, and if they're able to execute, they should do quite well.
Yeah, it seems to me that as of today, if I were going to handicap it, you've got like that put them in a legitimate discussion as the second or third major player, depending on how you view Disney Plus, like whether or not it's core or sort of like the premier sort of subscription. I don't know, but I think most people would probably subscribe to two at a time, and I think HBO Max has a legit shot at being one of those many months of the year, if nothing else.
Yeah, I mean, I think we're huge fans of Disney. I think Iger over the years did an unbelievable job. I think they have the best content out there by a mile. They're number one, I think, at least in my book. And then let Netflix and Discovery kind of duke it out and see what happens. But he's buying some fantastic content. He has differentiated content. He has a history of making content. So we shall see. And you're certainly getting it at a much cheaper price than you are Netflix.
Yeah, I think the interesting thing that there's a lot of integration issues that they have to work through. If they can figure out a way to keep that HBO tile separate, I think that could be a nice competitive advantage, because there's something really nice about going to the HBO tile and knowing I'm going to have legitimate quality content. I mean, the thing I still don't understand about Netflix, and I have a lot of respect for them, but I still don't understand why it's so hard to search.
Yeah.
I just feel like I'm in the sea of stuff, and it's like, how is there... I know people tell me, well, just rate stuff and the recommendation algorithm will get better. I just don't find it happening. And that may be by design. I may be unique. I don't know what it is, but I'm just like, why is it so hard to find what I want to watch on this thing?
Well, I think the worst one by far is Apple.
Yeah.
I mean, that is just painful. Disney Plus, I think they did a fantastic job on. I like Discovery Plus a lot. Netflix is fine, but Apple TV is just, for a technology company, they really did a mediocre job, especially when everything else that they do is super easy to use.
Except for podcasts. They kind of ruin that. Their podcast app is terrible now, which is bizarre because it's where I used to listen to everything, and they made it so bad that I no longer listen on Apple. Yeah.
No. I think that's fair too.
But oddly, the stats on this pod, I don't know. It depends how you break up. So there's like Apple Podcasts and then Apple Core Media. The sum of those two line items is almost like 3x however many people listen on Spotify, right? But Spotify, that somebody's streaming. It's not download. And I don't know. It's hard to dig into the Apple stats and figure out exactly what's going on. But they definitely have the reach among this audience.
Yeah. No, I know for mine, the vast majority by far are Apple devices. I haven't digged in too much into the data on that. I probably should. But yeah, no, it's Spotify seems to be, obviously taking a big, big interest in podcasting, and we'll see what happens with it.
Do you consider yourself part of the creator economy?
I don't make any money on it, so
I don't make much either. So that makes two of us. I think it's the beauty of the companies that enable the creators.
Yeah, I guess a very struggling creator, but that's not necessarily my intention behind the podcast. I just do it because I like it. I think it's gets me out there, and I get to meet really cool people. I mean, otherwise, why would Ken Langone ever talk to me, or whoever? I mean, it's just, or Zaslav, and it's a lot of fun, and but yeah, no, I think very few podcasters make any real money. I think Joe Rogan is the
Outlier.
real exception.
Yeah, no
Yeah,
doubt.
he's the outlier.
No doubt. All right. So
Um,
anyway, I was jealous of you when you talked to Sirhan, and that's nerdy of me to say, but I'd be lying if I didn't tell you that $1 Million Listing wasn't in my family lineup.
yeah, I mean that's my one of the shows that my wife and I watch together. I enjoy it. We own stock in a company called Trinity Place Holdings, which is a microcap name. They basically have a property in New York that they're selling. It's basically a one. They have more than one asset, but it's the primary asset of the company. And Ryan Sirhan is selling the building. And so I called or I emailed the guy running Trinity Place and Mike Messenger and said, "Can you make an introduction?" He did, and Sirhan agreed to go on the show. He basically broadcast it from like a building that was under construction in like a side room with like an iPhone basically there. It was very odd, but he is a fantastic salesman.
Yes.
I mean, he could sell anything, and I give him all the credit in the world. There are a lot of people who've been on that show who didn't become nearly as successful as he has. I mean, he has taken every opportunity and just run with it.
Yeah.
And he's done a fantastic job. He started his own company, and he's really I admire it. But he is a fantastic salesperson, and as a shareholder of Trinity Place Holdings, I hope he sells out the building very, very quickly so I can get my money out.
It's a good sign when he is the person that's selling the building that you're tied to.
Yeah, no, the fact that he's willing to take it, because I mean he only has certain hours in a day, and hopefully he does a good job. And a year ago, New York real estate was, I mean, no one wanted to touch it, but it's actually, at least on the residential side, is showing some signs of life. So we shall see.
So on an idea like that, when you've got like one substantial asset and it's in the process of being monetized, how do you think about the cash shell that you're kind of going to own at the end of the monetization process?
Yeah, this one wasn't one of our better one of our better investments. So I mean, I think we should get some money back, but it's this actually used to be part of Sims. And which went into bankruptcy. And the reason, Michael Price is the largest, I believe, shareholder of this. And it was always a real estate story. And it's, just what could have gone wrong kind of went wrong with it, pandemic, etc. But, they're coming to market soon. Hopefully they sell it, and, what they do with the company. And he just put some more money into it recently.
Michael Price did?
Yeah, they just had a rights offering because they needed to pay down a loan. But yeah, no, the New York real estate market is tough, and investing in microcaps is can be challenging. As I said, a lot have worked out, some not so much.
Yeah, well, I guess more than the specific result in this case, I'm just curious when you have a singular asset like that, and then you've got a cash shell at the end of it all, and maybe you're a minority shareholder, like just kind of how do you think through that? It sounds like having Michael Price involved is maybe part of having eyes that are aligned, that have a seat at the table.
You had some really good shareholders in there. Third Avenue is a major shareholder. The Kahn brothers, Kahn Asset Management there. So some really good value investors and some good traditional real estate investors are there. And I think in something like that, you just size your position accordingly, because, it was never a big position of ours for the reason it's a one asset company. And while I like the building, this is not like owning Madison Square Garden, where you're owning an iconic property. And, I don't use the word iconic lightly. That's where I would put more money to, where you have just fantastic assets that have the potential of being monetized. There's only one Madison Square Garden, there's only one Knicks, there's only one Rangers. So that's where I kind of prefer to kind of place our bets.
Yeah. Well, that's kind of what Mario said to me when he said that you're from Chicago and you don't understand the asset, right? Which, I guess the other thing that I didn't understand fully is how Isaiah Thomas was still around. But the Knicks, it doesn't matter. People will go no matter what. That's what I have kind of determined after watching the Knicks for almost a decade.
They finally turned the corner a little bit. I think they made the playoffs last year for the first time in 8 years, if that's turning the corner. But to us, and the theory behind Madison Square Garden, basically now you have two entities. You have Madison Square Garden Sports, MSGS, and MSGE, which owns the arena. It owns the air rights above the arena. It owns something called the Sphere that they're building in Las Vegas. They have some very interesting assets, the Beacon Theater, Radio City Music Hall. So they separated into two.
Don't they own the Chicago Theater too?
They either own it or have a long-term lease.
And they got something iconic in LA too, don't they? And Philly also. They got some good properties.
They had the Forum, which they sold.
That's right. That's what I was thinking of.
They recently sold it for a lot of money. They did a really good job there. They're much better capital allocators than people give them credit for. And what's really, to me, interesting is you take any activist investor or anyone for that matter, and they'd say 10 years ago, 15 years ago, you got to sell the Knicks. Listen, any Knick fan would say that.
That's different. It was like
you got to sell it. But, as we were kind of talking about before, sometimes doing nothing is the best thing. And the asset is appreciated. The Forbes, and believe it or not, people actually pay attention to these Forbes values. I'm not really sure why, but they do. They're often the starting point in negotiations. They raised, I think it came out 2 weeks ago, it's now $5.8 billion for just the Knicks.
Oh my, that's a lot of money. Or at least it used to be.
That's real money.
It's like $2 billion in 2019 dollars, according to Twitter.
It is. It's fantastic. It's insane. But then again, the last time the Knicks were up for sale, or Madison Square Garden was up for sale, was in the 1990s. So these things don't happen very often. So it's scarcity value in its most extreme. And there'll be a line of billionaires, I can't be that big of a line, but around the block if they ever put that up for sale. And the NBA did something interesting recently in that they're allowing private equity to take stakes in teams. So two things really could happen. One, they could sell both the Knicks and or the Rangers in their entirety, or sell the entire company, or to help put a marker on the team, they could sell a minority stake in either the Knicks or the Rangers, and help prove the value out there. And just as sports media rights has helped propel the valuation over the past 10 years or so, online sports gambling is going to really, both for MSGS and MSGE, really be a big deal. And I don't think people are appreciating it. There could be a sports book at the Garden. They own the RSN, the Regional Sports Network. They could change the name of that sports network to the DraftKings of Madison Square Garden Regional Sports Network. There's a lot of potential advertising things that could be done there. So these are the type of businesses we prefer to be involved in. And I think this gets back to some of your non-traditional value, because if you looked at MSGS from a cash flow perspective, you wouldn't get particularly excited. But if you look at it from an asset perspective, you would be a lot more excited.
Yeah. One of the guys that really got me thinking about like assets and whatnot and what you can do with them was listening to Ron Barron talk about Vail. I like how, he was saying that he was sitting around and just thinking about, okay, well, we've got these mountains and maybe to your point, right? The cash flow statement doesn't show great management today, but how can we flex these assets? And are these guys is this management team the type of management team that also thinks about this? And it's enabled me to see the possibility of value in these kinds of situations.
Yeah. No, it's not just screening. If it was screening for, value statistics or great growth statistics, and Ron Barron's very interesting in that he's a growth investor, but he's a very, very long-term patient investor.
Yeah.
And he bets on management teams. I have a lot of respect for some of the things that he's done. So he's super interesting.
Yeah, I think the only thing that would be I don't know, what do I want to say? The dumbest thing that I see investing bases doing is talking past each other rather than trying to learn from each other. So a guy like Ron Barron, a lot of value guys would be like, well, he's kind of pie in the sky and you got Tesla and this and that. It's like, okay, but also he's got Tesla and he's got Vail. And if you look at the valuation that he bought it at, optically that may have looked like a high price then, but look at what it's done now. And then then I get, well, multiple expansion, and it's okay. That's fair. But also look at how the asset base has grown in Vail and how they've really developed that. Like he's a true investor, right? He's not playing a stock trading game. So I respect that.
Yeah. It's not the style that I would necessarily do or comfortable with, but it works. And that's why I said before, you have to do what's comfortable for you, and that has worked for him. And he's not fly by night. He's been around since the 70s and 70s or 80s. I mean, it's worked over time, and there's a lot of different ways to invest. I think the important thing is to find a way that works for you and stick with it. Don't style chase. Don't buy Tesla because everyone's buying Tesla. Pick to something that you think that works, and don't abandon it just because it's not temporarily not working.
How has managing clients on the asset management side and managing research clients, are they similar to manage, or do they have I guess behaviorally, do they exhibit some of the same issues?
Yeah, I think it's somewhat self-selecting. We really fortunate in both of our client bases in that they talk to us if there's an issue, obviously, but they let us do our thing. They'll ask questions if something goes wrong or whatnot. But these are someone who wants instant gratification is not going to come to us. Or if they do, it'll be a very short relationship because we're long term. And, I tell people that, if you're going to give us money or you're going to be a research client, it might take a couple of years for things to work, but I think it'll work. And people who stick with us for a year or two will generally stay with us for a long period of time because they see that there's a process that has I think a pretty decent end game. In the money management, because we have some high net worth clients who are not necessarily they're sophisticated in what they do, whether it be real estate, dentistry, doctor, or whatever, but they're not stock market people. They, you might see, I heard this on CNBC, what do you think of crypto, that type of stuff. You get that less from the research side, but that's because of the media and Twitter and all these other things. I think it would be silly if they didn't ask.
Yeah, no, I know. I just I wondered whether or not both groups exhibited somewhat similar, I don't know, biases, for lack of a better term. I'm sure they're different, but
listen, people are people. No one likes to lose money. No one likes when your style isn't working and things are going against you and other people. And I think it's natural to be jealous of other people's success. So we're in the value camp and we see these people investing in Tesla, Bitcoin, whatever, making, or the Trump SPAC making,
it's crazy.
Yeah, making hundreds of percent overnight. Of course you're going to be upset about it, and I think that's human nature. So I mean, there are similarities and there are definitely differences.
There's a lot of value guys that I know that are actually like upset with themselves for missing the Trump SPAC, and I guess I guess I can kind of understand saying to yourself, there's so much gamble out there. How did I miss this? But every time I've had that conversation, I'm just like, I don't want the asset. So I don't care about missing the sort of memification of it. But it's funny how many value guys I've talked to that are like, oh, I should have seen that.
I mean, but when do you know to sell? I mean, that's
I
the
don't know.
thing. Like, it's up 100%. Why is it going to go up 200? Like, I would be a horrible trader. And there's, I have friends who do that, and they just do things differently, and that's fine. And they look at fund flows and they look at other things. That's just not how, that's not what I'm comfortable doing. And, hindsight is 2020. So
Yeah.
I don't think people. I think it's unreasonable to be upset with yourself if you miss the Trump SPAC.
I tend to agree. I think I would sell that if I was playing that. It would have to be on some sort of short-term moving average crossover. It would be a momentum break.
But the moving average of what, 2 days? I mean, it's like a 2-day moving
Probably.
average.
Yes, it would
It's
be
like,
really, really short.
yeah,
Which is not my game, but that's, I think,
yeah.
what I would do.
And it's such a harder game.
Oh, yeah.
I mean, it's to me, I really think investing in the long term is so much easier than this short term stuff. I mean, that is one, you got to be glued to your screen all day. And then you have the tax issue as well. I mean, there's just so many reasons to be a longer term investor. But I digress, and I think I'm probably preaching to the choir here. So,
well, I like talking about it, and actually, there was a thought that came up when you said that. I think that part of the disease that I suffered from when I sort of didn't understand what investing really was, and I thought I knew what value investing was, is I'd look at a multiple and I'd say, oh well, this is a 9 times EBITDA multiple. It should be 12. Like I'll buy it and then I'll flip it at 12. And what I've sort of learned over time. And it may sound really obvious to people that, have done this professionally for a long time, but the growth of the underlying business, right? People ask about, well, what will rates do to some of these long duration, Peloton type assets? The fact of the matter is, I do think that rates could hurt the valuation. I do think that people that are asking that question also have to acknowledge, however, that the valuation implies a lot of growth that is going to exceed the tick up in rates, and in all likelihood, right? And I don't think, if you've got any reasonable sort of risk premium on a given security, it's not as if most of these securities are trading. I don't know. I guess what I'm saying is I think the growth can bail you out of a lot of headwinds that. Even if you're hiding in a lower multiple stock thinking that you're going to avoid the headwind, I think that's a flawed way of thinking. I think focusing on long-term intrinsic value growth and what you're paying today is my version of margin of safety now.
Yeah, and it's interesting. I mean, you had mentioned earlier Curate, which is a name that we like. Selling at 3 times earnings. So I mean, yeah. It's really cheap. I mean, what you're betting on right now is you're not going to go back to like 2019 levels. That some of these customers are going to stay here, and if you believe that, in 3 times earnings is ridiculous. I mean, it's just stupidly
it
cheap.
Seems it to me, but you're preaching to the choir on this one, man.
Yeah. To me, that my Curate story that I think is crazy. I forgot when it actually occurred, but when the preferred came out, when he did the dividend, I think it was the fall of last year. But
it's almost 12 months ago.
I could be wrong, but for those who aren't following it, John Malone in his way, he did some special dividends last year, and then he did something called QRTEP. He distributed that to shareholders. Gave you a preferred that I think yielded 8 or 9%. And, in our analysis, it seemed like it was money good. And in a 0 rate world, I'll take 8 or 9%. And when it came out and it was $97, I'm like, well, you got a pretty good bargain. Then it went to 95, 94, 92, 89, 87. I think it ended at 87, I think. But it was you look at yourself and you say, what did I miss? What are other people seeing? And, it's really, this is the epitome of, this is not an efficient market.
Yeah.
You can get these situations where you can get, I think, an almost money good security and or preferred, and get it at a ridiculously low rate. Now, after things stabilize and I guess the forced selling ended, now trading at 108.
Yep. Yeah, 109
so
today, actually.
109.
108.95, but who's counting?
Yeah. But that's, I mean, it's just, that kind of stuff is just, to me, mind-boggling.
Well, this is famous last words here, but the question I can't ever get myself to answer is if it is true that QRTEP is money good, and it is true that there's 9 more years on that asset from a duration standpoint, then how is QRTEA a bad bet? Like, that's what I just can't get to. Because to your point, I mean, we're talking about somewhere between, I don't know, 3 and 5 times cash flow, which to me implies a duration shorter than 10 years. So, we'll sort of see how it all turns out. I don't know. People tell me that I'm hammering confirmation bias into my head. But, with that business, I kind of just look at it like, if I own the whole thing, I'd be super happy. And the hardest thing about owning that business to me is just the constant quotational, just like some days it just gets puked. So if I don't look, I'm probably going to do much better as a shareholder.
Yeah. No, I mean, that's the thing. It's also one of the things with clients, like on our money management side, some of our worst clients historically have been real estate, and with exceptions. I mean, some have been very good clients, but real estate investors who are not used to having a mark. And that's why you can't look at your screen every hour. You'll drive yourself absolutely nuts. Think about if you're a real estate investor and you had, what were your properties worth in March of 2020? I mean, they were down just as much as the stock market was during that time. You just didn't even have the option to sell it.
Yeah, that's right. It's my buddy Mike. He likes to say, my mark to model is much better than my mark to market.
Yeah.
Unfortunately, you can't market your mark to model, right? It's funny. Yeah. So when you entered investing, sort of, how did you kind of come in, and do you mind sharing like big mistakes? I like to talk about these, like what formed who you are today and why you invest the way you do.
Yeah, I mean, I would for sure, it would be my father. I mean, I work with him now. I grew up hearing this at the kitchen table. I love investing, and he's always made it a story. Ever since I was younger, I heard the Tiffany story where in 1975, he bought Tiffany and Company, where he could have bought the whole company for $24 million. But the real estate it owned on 57th Street and Fifth Avenue was worth more than the market cap of the company. And, a few years later, Avon Products bought it. But like when you grow up hearing those stories, like I don't get, not to say I don't agree with what Ron Barron's doing. He's obviously been enormously successful. To me, there's just really no other way that I would feel comfortable investing. And that's because of how I grew up and what I was taught. And, obviously I don't agree 100% with everything, investment my father pitches. We're obviously very different people, but, the framework I learned was certainly from him. And then I worked for Mario for a while as well. But there's a lot of obviously overlap there, and you learn through. Everyone makes mistakes. I still make mistakes. I mean, no one's perfect in this. I think my biggest mistakes were averaging down on stocks that I probably shouldn't have. And selling too early in a lot of other names. I mean, I think those are probably the 2 biggest mistakes that you really have to reevaluate your thesis. You're not smarter than the market in a lot of ways, in a lot of instances. And if a stock goes down 20, 30, 40%, it could be a great opportunity, but you should also really look at it extremely critically before you buy it. I mean, if it goes down 30 or 40% because the whole sector is down or whatever, but that's one thing. But if it's a company specific issue and it keeps getting hammered, you should really reevaluate your thesis before committing more capital to it. And I think that's something that I've learned, and will continue to learn. I'm certainly not perfect, and this is a business where you continually learn throughout your whole life. And if you don't, you're doing something wrong.
I like that you said that. I had a conversation with my wife about something that is down, a decent amount. And she said, the old you would have said the stock's cheap. And I said, yeah, well, the new me has learned something.
Yeah.
Right. Like the new me is not selling, but I acknowledge that maybe there's something I don't see and that I should allow more data to come out before I go jumping into more pain.
Yeah. No. It's, maybe you just keep your existing position and hope you're right. But listen, could be times where this is a fantastic buying opportunity. I mean, I think, for example, Scott's Miracle Gro going down from 250 to 150 in 4 or 5 months. I don't think I'm catching a falling knife here. I think there are real reasons why the stock has gone down, some fundamental, some not. I think that the cannabis flows probably do have something to do with it and sentiment. But you have to really think about it, and what's your downside, what's your upside, and not just rely on the research you did 5 months ago.
Yeah, I think in a name like that and some of the other names that I look at, I do think the market got ahead of itself generally coming out of 2020, and we sort of had like a little bit of a blow off top. When I say top, I don't mean like I'm making a market call. I'm just saying I think things got a little bit heated, and now when I look at my portfolio on like the underlying, on a fundamental basis, I'm more comfortable with where things are trading after, giving up a bunch. Now, why I didn't sell back then, I don't know. Some of the answer is I have given some more merit to this never sell idea. I think that not cutting things short is probably a better idea than I used to think. Because to your point, I made some mistakes, like selling Apple, I don't know, when it crossed $1 trillion or whatever. Pretty stupid idea, especially when simple math could have helped me. But I digress. Those are different issues. I don't need to confess every sin.
Yeah, no, it's these are things you learn of, and the problem with selling is when you buy back.
Yeah,
like that's the other thing, is it's psychologically very, very difficult to do that.
Yeah.
So the market clearly got ahead of itself, but so you have, and there's been a stealth bear market. I mean, there's a lot of stuff.
I'm telling people it's a bear market. Some people just don't realize it yet.
Yeah. I mean, there really is. I forgot what the percentage is, but there's a significant amount of companies that are selling, 20-30% below their highs. And, you have 10 stocks that are popping up the averages. So it's now is a good time to be investing in some of these things.
Does this remind you of anything that you've seen in the past, like these market conditions, or is it fairly standard, or none of the above? Just kind of, how do you think about where we are, or do you not even pay attention to it?
I mean, I think I'd be lying if not paying attention. Yeah, I think I'd be lying if not paying attention to it. Whether do I let it bother me and do I do things?
Yeah.
Because of it. I think what's just really interesting is how quickly the corrections are and how quickly we recover. And I'm not talking about the technical definition of a correction, but like all these dip buyers that are coming in, from the Robinhood crowd or wherever they're coming from. You have like a 4-day correction, and then things kind of settle back up, but they're buying a select number of stocks. It's a very weird time. I think it has to do a lot with where interest rates are. There's really is no other kind of alternative to invest. So it's, we have a really weird setup, but I imagine people investing in the 1980s thought something similar. This is a very strange time to invest. And in the 1970s with stagflation or whatever, it was, this is what you get paid for. This is what, the payoff is try to study, what you think is going to come I'm not saying next, but what's going to happen in 2, 3, 4 years from now.
Yeah. I have not studied too much of like market history. I acknowledge that's probably a dumb blind spot that I have, but I'm more focused on trying to figure out where we're going than where we've been, because I feel like, and this is potentially a dangerous statement to make, but I do feel like some people that I've watched their careers morph, the lower their returns drift, the more they start writing about how the market is and what rhymes with before and why this time's not different. And I just don't want to even like go down that path, because I think it's a more efficient use of time to just try to figure out where things are going instead.
Yeah, I think it's a kind of healthy to do a little bit of both. Yeah, you can't focus on the past and try and, but it's healthy to study it to see what happens. But today is very different than it was 50, 60 years ago. And you're not making policy, you're making investments. So it's not like you have to study what happened coming out of the Great Depression and you're the Fed governor or whatnot. You're trying to figure out different businesses and how you think they're going to be a few years from now. It's, you don't have to get too bogged down, but I think it is important to know kind of, I think especially how cheap things can get.
Yeah.
Like how ridiculously cheap things got in the 1970s, to say that something that's selling at 5 times earning, 10 times earning can't go to 5 times earnings. You have to look back. They certainly have.
Yeah.
And that, I think that's the valuable lesson.
I try to tell my mom that when she talks to me and she's like, well, this stock has gone down or whatever. And I just tell her, mentally think it can get cut in half again. And if it happens, then you won't be shocked. And she's like, well, why would that happen? I said, I don't know. I don't know why it's down now. I don't know why it would go, why would it go? I have no idea. There's impossible things to predict.
Exactly. 100% agree on that.
I mean, do you have anything that you want to chat about? What's on your mind? Anything that's a burning desire to get out that I haven't asked you about?
I think we've said a lot. I've enjoyed being on. As I said, we're long-term patient investors, whether it's on the research or money management side. It's the same thing. I've been, as I said, I've enjoyed being on the podcast, and I hope you got an idea of the type of names that we look at, and our philosophy and how we come up with stocks, and really the importance of patience and sticking to a style that you think works well is, to me, critically important.
I have a question for you. How as a firm have you all, something I admire about having a research arm that you've done is you're putting out your proprietary work, and you do charge for it, but a lot of people would hoard that work and say, well, this is more the asset management work. And I think that you've led in sharing research, and also I think your podcasts are great. And I'm kind of wondering if that has created a reciprocal sort of flow of information back to you that you think has made the firm stronger.
Oh, I 100% think publishing research has made us better investors. I mean, getting critical feedback from what I think are some of the world's top investors. They're not afraid to tell us when we're wrong. They're also, complimentary and let us know when we think we have a good idea. That's really helpful. When I see that something's really resonating with certain investors and they're really digging in deep, that's helpful. And, I realize they're pitching their own book, and they realize that we have a decent sized audience, and we maybe will potentially write up the name if we think it's undervalued. We hear their ideas as well. So it's definitely a two-way street in terms of idea generation. It's quite helpful. And it also, I think a lot of money managers recycle their ideas. We're in the idea generation business, for at least on the research side. So having to continuously come up with ideas to a very sophisticated audience. So you can't, call it in, not that we would ever, phone it in, is, really helps us. Yes, we're giving away the quote unquote secret sauce, but we're giving away, 25 ideas a year. But I think we get back a much more than we give in terms of the feedback. and the process of actually putting pen to paper and organizing your thoughts. I think that's extremely valuable as well.
Yeah, I love that answer. I don't know many people that have sent research out into the world that have said that was a bad decision. And like for me, I sent out a tweet, I don't know, a little while ago, but I said like one of the things about doing the podcast is that it's made me much better because I mean, I get to talk to people like you. I don't want you to think I'm a fraud, right? It's like I gotta work so that I'm prepared for these things, and that, you know, if a name like MSG comes up, I have a sense of what's going on because it's not scripted. And I think I would really encourage people generally to try to share. I think as long as it's thoughtful and it's done well, the benefits outweigh any costs.
Yeah, absolutely. And, our it's also, we're not moving markets. Our investors are very sophisticated people. They're not buying something blindly because we wrote about it. And, it's not like we're disadvantaging our own investors. So yeah, I think it's positive, a real positive thing. It takes a lot of time, but we obviously get paid for it. So that's good. But I don't think the money management business is a better business, but I'll never give up the research, or I don't think I ever would, because I think it really helps us.
Yeah. Where can people find you, by the way?
We're at BoyarValueGroup.com. That's Boyar with AR, because no one ever spells it correctly. And, or just follow us on Twitter at Boyar Value, and, you can reach us that way. And, if you have any questions, I'd love to chat with your audience and talk ideas.
Yeah, we'll drop some links in the show notes. And you've been on, I think you were on Andrew Walker's pod, right? We'll link to that. And whatever you want me to put in there, just let me know. So yeah. I look forward to speaking to you again, and thank you for stopping by the Business Brew. And here's to the beginning of a long relationship.
Absolutely. No, thank you very much for having me. It was fantastic, and this was great. And thanks for having me on.
Absolutely necessary. But it's absolutely necessary.